Hi, I'm Patu from freefincal. On this video, let's talk about how to book profits from mid and small cap funds tactically and whether it has actually made some sense to do so in the past with the help of a backtest. So for this backtest, I'm going to consider two strategies. One is investing in just one small cap fund, and the other investing in a combination of a small cap fund and the Nifty 50, or investing in one mid cap fund and investing in a combination of Nifty 50 and a mid cap fund. So those are the two different comparisons that we will be talking about. And for this study, what I've done is to take the 10-month moving average. I have already published a video on how to use the 10-month moving average to tactically asset allocate between equity and debt. So what we do is to look at the 10-month moving average of either the mid cap index or the small cap index, depending on what you want to time. And if the current price of the let's say the mid cap index is greater than the 10-month moving average, than its 10-month moving average, then you buy mid caps, then you sell all your Nifty 50 holdings, and then you invest all that into mid caps again. Then again, when the current price is lower than the 10-month moving average, then you sell all mid caps, take that money and put into Nifty 50, and also make further purchases also only in Nifty 50. So this is how you time. So this we are going to compare with systematic investment in mid cap fund alone. So for the funds, I have considered the Nifty 50 for the large cap and the Nifty mid cap 150. Also for the small cap comparison, I have considered the Nifty small cap 250. I have not considered any active funds because that will bring in some biases about which fund to choose, which not to choose, and so on. I don't want to get into that kind of a problem. So I just want to look at the method and with the 10-month moving average. Please consult these articles for full details on how to use the 10-month moving average. So the first result that you see here, there are 43 10-year runs, that is 10-year durations possible between 1st April 2005 and of course August 2019. And you can see here the XIRR tactical represents the annualized return of the tactical portfolio, that is the Nifty mid cap and Nifty 50 tactical portfolio. Whereas the XIRR systematic means just the investment in the mid cap fund alone. You can see that the annualized return of the tactical portfolio has always been higher than the systematic portfolio. Of course, the quantum of outperformance depends on whether there was a market crash or not. If there was a market crash, for example, the 2008 crash was there within the 10-year period, then the outperformance is much better when you do tactical asset allocation, otherwise not. But of course, you can't say whether there will be a crash when you invest or not, so it's better to always time if you want to reduce risk. That's the main point that is seen here in the bottom graph. So what you see in the bottom is the maximum drawdown, that is the suppose the index is here, how much it falls from the maximum. It's all-time high, from its all-time high, how much it is falling. So you can see that the systematic maximum drawdown for each run is higher than the tactical, so that the reduction in risk is quite significant. I have also done another study where I have done tactical asset allocation based on two 10-month moving averages, that is both the 10-month moving average of the Nifty mid cap index and the Nifty 50. I have presented the results in the article. I don't want to discuss this in the video because it becomes too confusing to look at it. So that's that. And these are two. So I said I looked at I said I looked at 43 different runs. So two such runs are shown here. The first one is start date is 1st July 2009, ending 1st July 2019. Notice that there is no big crash here, and the outperformance of the tactical portfolio is only marginal in this case. Whereas something beginning January 2006, ending January 2016 has seen that big crash here and then the big uptick here. Because of that, the tactical portfolio has done much better in those cases. So that is the case for mid caps, and you can I have repeated the study for small caps as well, and this is the study with the small caps. Notice that the quantum of outperformance is clearly much higher than in the case of small caps. That is the reason why I keep saying you should always book profit from small caps. Just don't keep systematically investing. It's not a good idea. And notice how much there is a big difference in the drawdown as well. Significant risk reduction, also return enhancement in the case of small caps. So this is again two such examples. You can see here, even when there is no big crash, the top graph, you can see how much the tactical asset allocation has made a difference, especially in the fall since January 2018. You can see the big difference here, and that is, I think it's quite amazing. That's why I think I strongly believe that if you must invest in small caps, you should do tactical asset allocation. So, should you book profits? I have always said stay away from small caps. It's not necessary. But if you think small caps will give you that extra gains, then I really think that you should have a proper tactical asset allocation strategy. This is only one example. Maybe you can do this for mid caps. Yes or no, it depends on what kind of temperament that you have. But whatever it is, unless you have a well-defined portfolio where you say this much is large cap, this much is mid cap, this much is small cap, unless you have a defined portfolio, you cannot do profit booking or tactical asset allocation. So first, focus on building that, then you can consider such a strategy. So that's what I wanted to convey in this video. Please check out the articles for the full details, and let me know if you have any questions. Thank you. Bye-bye.